Thanks everybody for attending DAT Summit. Excited to be with a very good friend of mine, Richard Galvin, one of the smartest fund managers I know in the world. Has put up some outrageous returns over the years. Ex-Goldman and comes from a TradFi world and went crazily into the crypto world. So excited to chat with Richard about what the current state of the market is and what the plans are for or what the year ahead lies. So maybe Rich, you can give an introduction to yourself.
Yeah, thanks, Phil. I've been in crypto since about early 2017. As Phil mentioned, I came to it from a TradFi background. I was a telco media technology banker at Goldman and JP Morgan for about 20 years. My attraction to crypto was I kind of saw as a young banker back in I'm pretty old, so as a young banker back in the mid-90s, saw that whole internet kind of boom come to public markets, got to see kind of the craziness around how disruptive tech can, one, be valued, two, can be an investment opportunity, and three, can decimate existing markets. So when I left banking looking for something new, randomly found my way to crypto and could just see the same sort of movie playing out again. So, I've been investing in institutional and family office capital through the crypto space for, 8 years now.
Just to go through DACM, how long have you been around? And let's talk about some of the returns and also the strategies you're running.
Yeah, so we started the business back in mid-2017, started running first institutional capital late 17. Our focus has always been around the coin and token space, so the native tokens in crypto. That's what got me super excited about this space. That's what, I guess, when I was talking to the entrepreneurs about the crazy things they wanted to create, that was how they were going to express the value they were creating through that coin or token. So we've always focused primarily on that coin and token sort of native asset. We work across what I'd say is kind of the life cycle of crypto. We've run an early stage venture fund since August 2018. Phil mentioned our returns. That fund's been a big success for us. It's very early stage focus. It's invested in things like Solana and Avalanche way back when. And we run probably one of the longest running liquid funds that just buys and holds and invests in the liquid crypto market. And then a market neutral fund where we try to hedge that strategy to make just a more consistent return. So we try to do everything that's across, apart from sort of quant trading, programmatic trading, we try to do everything across kind of the crypto risk spectrum. It's 15 people in the business. We're based out of Sydney, but our funds are out of the Caribbean and the vast majority of our capital's from the US and the UK.
Cool. So let's get started. I had a very easy thesis this year. Trump's in, buy Bitcoin. I'm going to make a fucking fortune. It's going to be 200, 300,000. What went wrong? Why are we here? What's going on in the markets here?
Yeah, it's probably been one of the toughest kind of thematic environments for me to explain to our clients over the last 8 years. So it's kind of hard to put a finger on anything too specific. Liquidity environment's probably been worse than most people thought. Crypto seems to have been caught in the crosswind of a poorer liquidity environment, being used as somewhat of a risk-off type tool, predominantly in a lot of exposure to headline risk. And I think the other factor has been it's coming up against the ingrained belief that crypto has a programmatic 4-year cycle. And I'd argue that's what we've seen the last couple of months is people that don't believe in the 4-year cycle buying from people that do believe in the 4-year cycle. So we've seen a lot of turnover and a lot of churn as we've kind of seen what I'd say is a dispersion of ownership across the space. Added to that, it's been a market where if you look across other asset classes, everything else has been pretty strong. So crypto's had a pretty poor competitive structure in that sort of high risk, high reward market. You've seen a bunch of returns out of AI stocks, infrastructure around AI, quantum computing, all those sorts of things have delivered pretty spectacular, albeit somewhat short-term gains. And that's taken a lot of the short-term liquidity out of crypto and created a pretty bad, I think, competitive environment for it to attract new capital as well.
What's the? Let's talk about some macro risk here. With policy risk as well with the Trump administration. What are you feeling we're at, and the 2026 ahead?
Yeah, I mean, it would be difficult to be more comfortable with the policy settings than there's ever been in crypto today. So I think you can kind of cross that off the list as one of the issues because, if anything, it's a massive tailwind. And I guess, with hindsight, some of that probably got priced in pretty quickly post the November election. I think crypto's kind of been disregarding a lot of the macro stuff the last couple of months. It's been trending down in a pretty strong bullish kind of equity market. I mean, if you look at crypto space, what our market's 30% from all-time highs, depending on what sort of index you use. Equity markets are 150 basis points. So it's been it's either the canary in the coal mine that's telling you that things are going to get worse for growth assets elsewhere, or it's more of those idiosyncratic factors I talked about before that have been playing on its sort of short-term performance. We'd be in the latter camp, and we still think, particularly with midterms, those sorts of things coming up next year, with the state of the economy still looking pretty good, that the macro environment looks okay. And we actually think now is probably a pretty good opportunity in crypto. If you look outside of the top 10, for example, year to date, if you strip out the top 10 tokens, I think crypto's off about 74%. So it's a pretty stark environment. But if you look about making long-term returns in crypto, as long as you're not buying the highs, you're generally doing okay. So we can be pretty assured you're not buying the highs if you're buying crypto around here.
Yeah. Interest rates, big thematic. Trump's pushing Powell to cut. Just give us a quick scenario of he cuts half a point. What does that mean for Bitcoin? And we're going to hold you to it as well. If you're going to cut it a point, what does that mean for Bitcoin price? Because I know that's the benchmark for everybody.
Yeah, I think we're generally, as a venture investor in our funds with a sort of 3 to 5 year view, we generally don't have a great track record of calling short-term, and we don't spend too much time trying to predict kind of short-term gyrations. I would say, though, I would expect the market to be much stronger by the end of January. Now, whether that means we're coming into year-end where there's a bunch of tax loss selling and those sorts of things potentially weighing on the market, whether that means we get from here to January up or whether we have to wait for the new year, I'm not too sure. I think on an interest rate environment, we're pretty... Trump's pulling all the levers that he can to get what he wants, and I think he probably will. So I think it's pretty hard to be bearish on the rate outlook in the US. You can be bearish on what that means for the credibility of bond markets, and we are, and we think that's super positive for Bitcoin. But I think you'll probably get the rate environment that Trump wants because he'll just kind of make it happen by getting the people to do his will. I think that kind of leads to what I think probably the bigger thematic for Bitcoin. I think the fact that the bond market is becoming a much more captured asset class and a much more, for want of a better word, manipulated in terms of the way it trades, I think that's actually much more bigger tailwind for Bitcoin than short-term kind of interest rate moves. And so having people reallocating, which is, I would argue we've seen over the last 3 to 5 years, having people reallocate from sovereign bond markets to other asset classes has been part of the reason we're kind of in that everything up type cycle. And I don't see anything that makes that end soon. Unless governments are all of a sudden going to become hugely fiscal responsible, which I think would be a really bad bet, I think that trend continues for 3 to 5 years at least.
Sure. I learned a new expression this year. In crypto, there's a strong thematic and everybody jumps on it and then they start calling themselves a new name. In this case, it was Perp Maxi. I'm like, what the hell is a Perps Maxi? And they're like, I'm really a believer in Perps. Let's talk about, maybe JGBs and leverage in the system. How much is there? Does that concern you on a day-to-day trading?
Not in crypto. I think if you look at crypto space, unfortunately through 10th of October, jettisoned a bunch of that leverage and has seen it trend down since. So if you look at sort of leverage to market cap, open interest across certain metrics and those sorts of things we cover, it's pretty low. So that doesn't mean the market spikes straight out of that, but it does mean it's a pretty constructive base to build from. I would say that if you look at assets, which I do, if you look at growth assets as a mix of cash flow and speculation, the speculative aspect of crypto at the moment is probably as low as it's ever been in my 7 or 8 years in the space. So if you're looking for how much is there left in the price based on sort of hype and upside, versus how much is there left in just sort of fundamental asset type value, we would say the speculative part of it's probably negative, if anything. And that from our perspective, you see that in the leverage in the space, and you also see that in the way that assets are being valued. And so you've got a very constructive base to build from, to grow from. Now that doesn't mean that gets righted or that gets corrected in 4 weeks, 5 weeks, but it does mean on a sort of 12 to 2 year view, it probably gets bid to what I'd say is a healthier level.
Okay, DATs. Yeah, thematic of what is it like? We've had meme coins, we've had Trump, DATs. The next thematic, obviously, boom, and now we're trading at discount to NAVs. What do you see, the impact on the market, and why haven't some of them performed, on the underlying token when they've launched? And what do you think of the thematic for next year and DATs?
Yeah, I think there's a lot to cover there. So let's think about why DATs came about, in my view. So if you look at crypto, I've just sort of, in a couple of earlier comments, mentioned how poor crypto's performed this year versus other asset classes. So the interesting thing about that, which is kind of new for crypto, is that at the fundamental level, it's actually performed really well. So user growth, revenue growth, all those sorts of things have actually been super strong and at complete odds with price action. So if you look at it from a valuation perspective, however you want to cut it, it's kind of got way cheaper because prices have come down 70% outside of the majors, and fundamentals have probably grown sort of triple digits on both measures on a year-on-year basis. So you've seen to use an old equity term, you've seen a massive multiple compression across the crypto space. Now, how does that get fixed? It generally gets fixed by people with big wallets taking a long-term view and buying and holding assets. That's generally what's happened. That's what happens in equity markets. Crypto doesn't have many big wallets, and it's extremely short of people with long-term views or outlooks in the space. And so from our perspective, we see this crazy kind of value available, but we couldn't see the bridge as to how the capital gets to buy it. And then markets, you've worked in banking as well, Phil, markets are pretty good at working out how to bring capital to value. And I guess that's kind of what the DAT trade was, in our view, finding excess capital in equity markets and bringing it to a crypto market that was starved of new capital. And so we saw that wave of Wall Street doing what it does really well, which is bringing excess capital and executing upon a new structure pretty quickly. Now that led to, however you want to look at it, maybe like $100 billion inflow to crypto, which is pretty bizarre because it's $100 billion buyer into closed-end funds, and crypto is actually trading lower than when it started. So, it's kind of led to no sort of price appreciation. And then we've seen, a pretty weak DAT market as, Wall Street does what it does, which is kind of flood a market with a new opportunity, which it does if you look at anything short term. Our view looking forward now would be that you'll see two things. You'll see consolidation in the DAT space. We don't need 153 Bitcoin DATs in the one region. So I think you'll see the strong by the week, because that'll probably be the cheapest way for them to acquire more Bitcoin is just buy a treasury company at a discount. But this stuff takes time. Like anyone that's worked in equity markets knows, through boards and through regulation and those sorts of things, you don't just go and buy an equity company in a couple of weeks. That's a 6, 12, 18 month type process we think will play out. I think the second thing we'll see is the DAT market adapt and become more company-like as opposed to treasury-like. So we've seen some of them. We invested in a DAT for NEAR protocol, which has done this where the protocol's also going to buy a bunch of infrastructure and actually help the network. So not only buy the token, but also buy infrastructure to support the actual operation of the network. And that does a couple of things. One, it generates cash flow outside of just a stack of tokens. Two, it gives back to the ecosystem, so it uses that excess capital or that capital it can access to help sort of turbocharge it. Three, it gets the vehicle away from being just a look-through NAV vehicle, right? Like it becomes a company with a bunch of assets in token, but also an operating cash flow type model longer term as well, which is a much more sustainable, much more growth-focused win-win model in our view from an equity investor perspective, but also for tokens in terms of it's giving much more back than just buying and holding tokens.
Okay, betting markets. I think this is super interesting because, when you get two PhDs ex-Citadel and they set up a company and raise a lot of money, and this thing's blown up this year. and obviously Polymarket as well. Can we talk about that as a fund manager? Like, it allows you to hedge political and macro risk, with liquid markets, right? Is this going to be a strong thematic as well? And give us a thesis on that.
Yeah, I think prediction markets are something everyone in crypto should be cheering, because it's kind of a perfect example of what the space needs, a new kind of product in a way, but with I'd say the killer app in prediction markets is the interface. Like anyone that's sort of, I have gambled a little bit in my past. Gambling markets can be difficult. They're quoted differently around the world. You got crazy odds markets in the UK versus Australia, for example, in terms of getting your head around them, not sort of super accessible for a bunch of people. And also on very strict and regulated, refined things that you can gamble on. What prediction markets do is effectively allow you to gamble on kind of anything. And I'd say the killer app they've come up with is they've made that in a really simple user face where you've just got like a green and red button and you click the one you want. And we've seen that once you get that right, once you make it easier for a mass market to approach a product, that's where you get the killer kind of growth that we're seeing in poly markets and Kalshi. And the crypto part of those businesses is extremely small. Like they're using a crypto rail to get assets in there, but it doesn't feel like a crypto app, doesn't look like a crypto app. So they're scaling. This is exactly what we want to see in crypto. New use cases using smart UIs, which crypto generally hasn't had, right? Like it's had pretty bad UIs, to be fair, pretty much until about 2 years ago, and they're getting rapidly faster now. And opening new markets up. So we're going from that sort of sandbox phase to that mass market phase. So I think you'll see a proliferation of those betting markets. The US election the US election was obviously kind of the watershed moment that opened it up, but now they'll do what most sort of new markets do. They'll go everywhere, and I think you'll be able to hedge a whole bunch of stuff if you looked forward on a 2 to 3 year view in those markets.
Yeah. In that crystal ball that you've got on your desk there with a bunch of PhD quants, what are we looking at for thematics for 2026? What sectors should we be in? And everybody's talking about AI. It also looks like a bit of a boom and bust as well. But what's your strategy for 2026?
Yeah, so we've had a strategy for about the last 18 months and to be honest, it's unashamedly just copying what happened in other disruptive tech cycles. And we don't see why today crypto's been kind of exactly the same. Our view is when you look at disruptive tech, and the internet's obviously the easiest example, you spend a bunch of time first building out the infrastructure, because there's no point bringing disruptive tech to a market without having the infrastructure to actually scale it to then mass users. And I would argue that's what crypto's done almost entirely for the last 7 years, or the last 10 years. Basically build out blockchains. Let's build out blockchains. We don't have enough block space. Block space is too expensive. Transactions are too high. So you've seen VCs basically add tens of billions of dollars to build out more and more blockchains, which is the same as, VCs funding routing and fibre optic companies through the internet stage to build out more capacity around the internet. So everyone piles into infrastructure that makes it much faster, easier to use. It means the stuff that you can build on top of it grows exponentially. The user experience gets better and better. You move on from a bunch of tech geeks that have to sort of understand coding to use the internet, to your grandmother now looking at the news on the internet, which is a moment that I can remember back in the early 2000s. So we think we're seeing the same thing with crypto. We've spent a bunch of time building block space out. We've got more than enough blockchains and block space now to build anything you want. It's really cheap and it's really fast. Things like Solana, those sorts of things that have just exponentially grown the amount of capacity in the space. We think we're moving, just like the internet did, into the age of the application. So we're moving on from that Cisco, Juniper networks, Nortel networks phase where they were kind of the glamour stocks to that phase where it's now, let's focus on the user, let's focus on the stickiest part of the market where you can grow revenues really fast and we can actually own the user. And so our view is we're moving through that phase now over the next 3 years of the application space. And that's where all our money is focused, on the VC market and on the liquid market. And I'll give you one stat which is kind of nuts, but if you look at blockchains as one layer of crypto and applications built on blockchains as the other. From a revenue perspective, applications about 3 years ago made, I think, less than 1% of the revenue in the entirety of crypto, and they made up 7% of the total value of the crypto the crypto ecosystem. Fast forward to today, applications now make 67% of the entire revenue pool in crypto, and they still trade at 7% of the value, which is just insane. So you've seen this massive kind of underinvestment from an investment perspective in that application layer. You've got a whole bunch of apps now that trade on, to use our old terms, filled PE multiples of like 4 and are growing at like 150% per annum. So that's where we see the value in crypto, and that's where our focus is for the next 3 years. Not specifically on each vertical, because I think there's a whole bunch of verticals, but on that real application layer where we think the priority or the bulk of growth comes over the next 3 years.
Fund managers hate it when you ask them this, like, but fortunately I kicked the compliance officer out of the room, but basically, what's your 2 most undervalued top 50 tokens? And then give us a moonshot as well for 2026, and I'll round it up there.
Yeah, I think, so we're focused around applications, and we're focused around applications that make cash flow, and then our view is then you buy the cheapest, highest growth. Solana is the absolute standout for an ecosystem from that perspective. The top 5 apps in Solana make about 1.8 billion of revenue on a last 12-month basis. They've grown at about 250%, 180%, depends on how you cut it on which month, and they trade at an average multiple of about 3 or 4 times. So to put it in perspective, NASDAQ trades on a revenue multiple of 6 times and grew at 16% the last 12 months. Crypto trades at a discount of that and grew at 10 times the growth rate. So our view is all the applications, the major apps in Solana, Pump.Fund, Jupiter, Radium, Camino, the ones that control the verticals into Solana are probably the best investment bet for us over the next 3 to 5 years if you've got to buy and hold something. And then Solana itself would be the only protocol we really spend any blockchain that we spend any time investing outside of Bitcoin investing in, because we just think it's the only one that's kind of scaling and showing actual growth metrics that you want to see from a tech type investment. Yet for whatever reason it trades at a massive discount to Ethereum and a whole bunch of its other peers.
Sorry, I missed the moonshot here. Like for the older generation, Blue Horseshoe, or for the new generation, DGEM, what's our moonshot for 2026 token?
Yeah, I think, look, I think we're in a period where you don't actually, if you look at the chart of the .com boom and bust, you kind of had this massive run up, then you had this big fall, and then you literally had like a 15-year grind of just great returns over and over and over. I would argue crypto's at the start of that period. I think moonshots are going to be fewer and far further between. I think it's going to be easier to make money just to buy and hold. There's a bunch of small DeFi names. We own a token called Chainflip, right? It's a cross-chain swap engine. It's doing about, it trades at like 50 million bucks. It's been around for 2 years. Does 3-point-something million, depending on when you cut it, 3.6 million of revenue at the moment, right? And does about 25 million of swaps a day. I mean, that's pretty cheap for a business that's 3 years old. It's trading on a cash flow multiple of, 10x. That's like buying a cement company, but it's growing at like 3, 4, 500% type multiples. So it's a lot of those sort of small DeFi names that have sort of come through this period, got real product market fit, generating revenue. They've done all the hard yards about building and launching a product, getting it listed. Now they're just focused on how do we scale it to like that sandbox user of 10,000 users to 10 million. That's where we think the gains come from over the next couple of years.
Well, obviously, Richard's super smart, and you could pay for this on Raoul Paul's podcast, I think, in a few weeks. So you got it here for free. Thank you, Nikki. Thanks, everybody.
Thanks for having me, Phil.